Imagine you're 22, just got your first job, and you've started to save a little money each month. You know you should invest, but where? Stocks seem risky. Real estate, too expensive. Then someone says, why don't you try a mutual fund? Meet Arav. Like many young professionals, Arav had no idea where to start. He stumbles upon the term mutual fund. Sounds boring, he thinks. But what he doesn't realize is that mutual funds have quietly created thousands of millionaires without the chaos of daily trading. So what exactly is a mutual fund? What is a mutual fund? You're at a party. Everyone wants pizza, but no one wants to buy a full one alone. So everyone chips in a little money. With that pool, you buy a big pizza that has different slices. One slice is pepperoni, another is veggie, and another is cheese. That's a mutual fund. A group of investors pools their money. A fund manager then uses that money to buy different types of investments, like stocks, bonds, or gold. Just like those different pizza slices. Key point: you own a part of the whole. Even if you only invest a little, you still get access to a professionally managed, diversified portfolio. If you invested in just one stock, say a tech company, and it crashes, your money goes with it. But in a mutual fund, your investment is spread across many companies, reducing your risk. Real-life benefit for Arav. Arav started with 1,000 rupees a month in a SIP, systematic investment plan. Over time, he didn't need to check the stock market every day. He just kept investing, letting the fund manager do the hard work. 5 years later, Arav had not only built a habit, but also a small corpus that grew steadily, even through market ups and downs. How mutual funds work? Simple breakdown. Investors contribute money. That money goes into a mutual fund pool. A professional fund manager picks the right mix of assets, stocks, bonds, etc. You earn returns based on the performance of the entire portfolio, and you can enter or exit anytime for most funds, making it highly flexible. Quick terms to remember: NAV, net asset value. This is the price of one unit of the fund. Expense ratio, the small fee charged by the fund to manage your money. Fund manager, the expert behind the wheel, choosing what to buy, sell. Key analogy: a mutual fund is like hiring a chef. Instead of buying ingredients and cooking yourself, you let a pro make the best meal based on your taste and budget. Arav now feels confident, but he realizes there's more to learn. What types of mutual funds are out there? And which one is right for his goals? That's coming up in Module 2, where we explore different types of mutual funds with real stories and deep insight. Arav, now a few months into his investing journey, logs into his app and is shocked. There are hundreds of mutual funds. Equity, debt, hybrid, index. Which one do I choose? This is where most beginners freeze. But don't worry. Once you understand the types, everything becomes clear. 1. Equity mutual funds. For growth hunters. Definition: equity mutual funds invest mostly in stocks. That means you're buying shares of companies, tech, healthcare, banking, etc. Story: Arav's friend Maya invested in an equity fund focused on technology. In just 3 years, her investment of $5,000 grew to nearly $8,500. But there was a catch. During a market crash, her portfolio also dropped by 25% before it bounced back. So, equity funds equals higher return potential, but more ups and downs. Types within equity: large cap, stable companies like Apple, Microsoft. Mid cap, growing companies, moderate risk. Small cap, high risk, high reward. Sectoral, focused on one industry, e.g. tech, pharma. 2. Debt mutual funds, for the cautious investor. Definition: debt funds invest in government bonds, corporate bonds, and fixed income instruments. Story: Arav's father, Mr. Sharma, didn't want any wild rides. He put $10,000 into a short-term debt fund and earned around 5% annually, consistently, with very little fluctuation. Ideal for retirees' emergency funds, short-term goals within 1 to 3 years, types within debt, liquid funds, withdraw anytime, good for parking money, short duration funds, safer for 1 to 3 years, gilt funds, invest in government securities, 3-point hybrid mutual funds, balanced and safe. Definition: hybrid funds invest in both equity and debt, a mix of risk and safety. Story: Arav's cousin, Neha, was saving for her wedding. She didn't want total safety, but also couldn't take big risks. She picked a balanced advantage fund. She invested $7,000, and over 3 years, her investment grew to $9,200, with moderate risk and less stress. Types within hybrid: aggressive hybrid, 65 to 80% in stocks; conservative hybrid, more in debt; balanced advantage, manager adjusts between equity and debt. 4. Index funds, the lazy genius option. Definition: these funds copy a market index like the S&P 500 or NASDAQ 100. No human actively managing it, just following the market. Story: Arav read about Warren Buffett's favorite investment, index funds. He put $1,000 in an S&P 500 index fund. In 5 years, it became $1,800 with almost no effort. Benefits: super low fees, long-term wealth builder, ideal for passive investors. 5. International mutual funds, go global definition. These invest in companies outside your home country, like Google, Tesla, or Amazon. Example: Arav wanted exposure to US tech giants, so he chose a fund that invests in global tech. It gave him 13 to 15% annualized returns, but also currency risk. Arav now understands mutual fund types, but he's stuck at a familiar place. Which fund is actually right for me? Choosing the right mutual fund is not about picking the top-rated one. It's about picking what fits you, your goals, your risk, your time. 1. Define your financial goal. First story: Arav's friend Ravi invested in a small-cap equity fund, but he needed money for his sister's wedding within a year. Result? Market dipped, he lost $1,300 and had to take a loan. Lesson: don't pick funds randomly. Start with questions like, why are you investing? When will you need the money? Can you handle ups and downs?